In this recording, we're going to look at the Summer 18 Question 1 of Financial Reporting, focused particularly on Part A, which is the preparation of financial statements. So again, make sure you've read through the question now, because I'm assuming you have a good knowledge of the question already. And my particular focus of the recording is on the approach you take to a Question 1. So in this question, you're told you're looking at Voltaire's financial statements for 2017, and it's after the year end. And they want you to look through them. You've been given a draft balance sheet, and they want you to figure out what adjustments are required. So usually question 1 here, it's usually around 50 to 55 marks. We're focused particularly on Part A, which is asking us for a statement of profit and loss, and other comprehensive income, and a statement of financial position. Now be careful, since 2017 they're also asking you to include the journal entries. So if you don't give journals and you don't make sure they're neat, you are going to lose marks. That usually doesn't take up the full question. So Part B and C, typical one is draft disclosure note, here relate to tangible assets, and also ethical issues. So again, they're common requirement, usually for around 8 to 10 marks, so don't lose out on those either. So I'm going to focus, particularly for this recording, on Part A. So if you see here, they don't give you any information in the main body of the part. You have to go to the appendix, which is on page 70. And again, I'll just show you the things. The first thing you'll always do is have a quick look at the trial balance, see is there anything unusual, and highlight it, and have a quick read through the notes to the financial statements. So just make sure you read through them and see what you highlight, and then I'll walk you through what I would highlight if I was reading it. Alright, so a couple of things I'd highlight here is you now have closing inventory and cost of sales in the trial balance. So that means closing inventory is in there twice, because of course it's already in cost of sales. The alternative way to present that is to give you opening inventory and purchases in the trial balance, and leave closing inventory outside. It's just way it can be presented either way. Current tax assets should always be flagged. That's unusual and is going to have to be dealt with. So it looks like that's a legacy issue coming forward from last year. You'll have to deal with, and usually given information in the notes. Finance cost paid, that always might be a red flag. There might be a difference between the amount paid and the amount actually incurred. So you can just watch the language, what the examiner's giving you. You're told the intangible assets at the year end. So that's not the start of the year. They're saying that's at the 31st December. Likewise with property, plant and equipment. So they've already done their amortization. They've already done the depreciation here. So sometimes they'll give it to you at the start of the year, such as retained earnings. That's at the start of the year. The other two are at the end of the year. So it'll only take a couple of seconds, but have a quick look through your trial balance. Does anything stand out as unusual that you'll have to come back to? And some students might use a red asterisk or something to note, I need to go back and look at all my red asterisks at the end of the question. The next step I always tell students to look at is do a quick high-level view of all the notes and financial statements here, and try and link the notes together if they're related, and link them back to your trial balance. So for example here, this is all about the intangible assets. They give you the balance at the start of the year, and you should be drawing a link to say, well, this is the balance they're telling me at the end of the year. So this is right beside it, that would be your IAS 38. So they're telling me what they expect it to be at the end of the year, based on all the adjustments. And we'll go through it in detail now in a second and say, well, are those adjustments A, B, and C correct? And if not, what adjustments are required? So all for now is I'm linking it to the trial balance, and I know it's IAS 38. And I know in the back of my head, Part B, I'm going to have to do a disclosure note for that. So you're just trying to get a sense of what's come up. Don't just ball into the calculation straight away without looking at all the notes, because some of them can be codependent. Next one is you bought a building, intention relocating staff, but then it was let to a third party. So straight away in your head you're writing down the key standards. That's IAS 16, because it was initially properly for your own staff, and now it's IAS 40, because it was let to a third party. So that's all you're writing down for now. There's clearly a transfer between IAS 16 and IAS 40, and you'll come back to it in due course. So you're just trying to get the standard, write it down, but don't spend too much time for now. Your Part 3, again, I'm assuming you've read through these. I'm just trying to go through it high level. You're looking at construction of a new factory, and they're talking about loan interest, and half the loan is unrepaid at the year end. So it's half loan is unrepaid, so you're linking that back to what we've already highlighted here. Finance costs paid. They don't have the full amount in. Just trying to make sense of the trial balance. And this is construction of a new factory. So the relevant here one is IAS 16, but also hopefully you copped IAS 23, the capitalization of interest. So you're linking it to the trial balance, and you're paying attention to the key information given. Closing inventory, measure the cost, but now reprocess it and have a 50% of normal sales value. So here this is IAS2. So you might draw a link between note 4 and what you know is your closing inventory up here. Just to say they are going to be linked, you're going to have an adjustment to it. But the normal lower cost of net realizable value should be nothing too taxing here. Here we have credit sales to a US customer for $200,000, but it's recorded as €200,000. And they've received a part payment they haven't recorded. So again, this is linking to our revenue figure up there. This is IAS21. So you're just in your head, I know what that adjustment is, and you'll tack them as required then as you go through the question. But it's always good at the start, I know I'm labelling it here, read through the requirements. Dividend was declared after the year end, highlight the dates, but they adjusted it before year end. So you have to make an idea, is that correct or not? Do you need to reverse it? And write down the standard. Show the examiner you know it. That's IAS 10. The final one then, the current tax asset, which we've already highlighted in our trial balance, 22. That was repaid by revenue, you're told, at the end of the year. Right? Or during the year, should I say. And then you have to estimate the tax charge for the year is 285. So both those tax fall under IAS 12. So your first part, always in a question 1, you need a structure to it. Figure out what the requirements are, which we looked at in terms of part A, B, and C. Sorry, put the right one here. So that's your first protocol. Figure out the requirements. Then always take a quick look at the trial balance, notice anything, and try and take a quick look at the notes. See, is there any notes that are linked together? See, can you link the note to the trial balance and what the relevant standard is? It's very good discipline. Should only take 1 or 2 minutes. But it sets you up now, you know what you're approaching when you're going to your question. And hopefully you'll do that in your reading time in your 20 minutes for the Cap2 financial reporting exam. The next step I always advise students to do is, now I'm going to do it in Excel, is set up a template. Leave 1 page for the P&L, leave 2 pages for the statement of financial position. Now you may not want to put in every line item, but I tell students put in some of the key ones and leave space. Because as you finish a particular item, or as you get an adjustment, you can slot them in. So you're not leaving it all to the end. Now you won't be able to slot in everything, but it's a useful thing every so often. If you have a template set up, as you finish with a working, and you know there's nothing else coming, because you've read all the workings already, well then you can slot them in and move on. So it's quite efficient in terms of a setup. So I'd always leave 1 page for the P&L, 2 pages for the statement of financial position, and leave a couple of lines spare for line items you may or may not have. And I'll always leave 1 page for a statement of changes in equity. Now we won't ask for it here, so you can kind of skip it, but it's no harm to practice it, just so you know how it works. So I would leave those blank. If you get a chance to fill in some of the lines, that's perfect, but you can fill them in as you go, as you finish your workings. It just helps you along when you're preparing the question. So what we're going to do is the next page then, we're going to go to our workings, and we're just going to label them working 1 down along. And remember now, the examiner has asked us for journal entries. So if you go back to your part A, since 2017, they've explicit requirements, show the journals as well. So don't lose out on those easy marks. So our first note then, working 1, will be our intangible assets, which is going to link to our part B as well. So now we know the opening intangible assets are given to us, as are the closing one. But some of these may be in error, so we'll have to figure out what is correct or not. So they amortize intangible assets over 10 years, full year and the year of recording. All expenditure and amortization including cost of sales. And they're telling you during the year here, they capitalize 100,000 regarding initial research work, that being the key word here, of a new product. We'll move to the development phase next year and into production May 2019. So you know that's incorrect. So you know under IAS 38, research work does not qualify for capitalization. So all I do is write down IAS 38, expense research work. So you're showing the examiner, you're not writing a big paragraph, you're just expensing it. So what they've done is incorrect. You should be debiting cost of sales, crediting intangible assets. And that will be 100,000 and 100,000. So I just dropped the last 3 zeros. You can do likewise. You won't get docked down for that. That's your first one. You're saying reverse that because it's incorrect. It shouldn't have been capitalized. It should have been expensed. Now bear in mind, you're already told they've already accounted for amortization because they've given you the final year figure. So we know that 100 has already been amortized, so that'll have to be an adjustment as well when we're going through the rest of the question. So just watch out for that at the end. We'll have to adjust for the amortization in a second. Second thing you're told is they purchased a clothing brand name for $240 and capitalized it. So nothing wrong with that because it was a purchase. But at the year end, they fair valued it up to $300 and they increased the assets and credited revenue. Now, under IAS 38, you can only recognize an intangible asset at fair value when there is an active market. There's no indication here that there's an active market. And even if there was, it's corrected or accounted for incorrectly. It shouldn't be credited revenue. So we're taking the assumption that there's no active market. So here, no active market, hold at cost. So you want to reverse that again. Credit, or you put here, debit revenue, and credit intangible assets. And that is going to be 60 and 60. Reduce your revenue and credit your intangible assets. So there's no active market there. If the examiner was looking for you to leave it in and just correct the revenue entry, they'll tell you that there's an active market. So in that regard, don't be too worried. The general assumption here is there's not an active market unless you're explicitly told. But remember, that would have been amortized as well now. That extra 60 would have amortized, which would have changed your adjustments. We're going to have to adjust for all that amortization at the end. And finally then in IAS 38, they capitalized 400 grand in developing 2 new jackets. Cost incurred is split evenly. So 200 on the lightweight, 200 on the waterproof. Confident development complete in May and sales will come into September. Completion costs have been provided for in the budget. So that means the IAS 38 criteria of having sufficient skills, having sufficient funds is met. And research shows a profitable market. However, clothing expert recently employed have only endorsed one of the jackets. Grave concerns about the waterproof capability. So that's a big concern here is the waterproof jacket does not meet the criteria that it's technically viable or technical feasibility. So that means it should be written off. You shouldn't be allowed to capitalize the development expenditure for waterproof because it doesn't meet the IAS 38 criteria. So you need to expense waterproof funds, which is 200. You want to debit cost of sales, credit intangible assets. So that's going to be 200 and 200. So if you look at the adjustment you've made, you've essentially said there was 360 of intangible assets overcapitalized. So that means 360k too much capitalized. And that means there was 10%, which is 36,000, too much amortized. Because it shouldn't have been there already, so it shouldn't have been amortized. So you're going to reverse that amortization, debit intangible assets, and credit cost of sales. So here you're going to 36 and reduce cost of sales by 36. So that's important that you realize that you're told in the question here that on page 70 that Voltaire had already accounted for amortization. So that means if you're reversing these, you need to reverse the amortization as well. Quite tricky. Now, one thing the students can do here to be efficient, and I'll leave it at the end because it'll be messy moving around Excel, is you have a number of adjustments here. You can finish off some of them. So say, what's the net adjustment for cost of sales? Bring that forward. Put the net adjustment for revenue, slot it into the financial statements. Or even for intangible assets, we're now finished with intangible assets. So we should know the last figure for intangible assets. You're going to start off with your trial balance. So per the trial balance, the closing amount was 19120 minus 360 for the adjustments plus 36 for the adjustments. So you're saying you can finish off that because you know that's the only adjustments you have there. And that's going to be 18,796. And you can slot that into your financial statements if you wish. So just trying to give you an idea. It depends what way you want to set it up. You might want to capture all the cost of sales in a separate working and just capture them as you go. Or you might want to leave it in the end. Entirely personal preference. Figure out what works for you. Sometimes I like to finish off with elements so it makes it easier to finish off the whole question at the end. That's our working one done. And remember, we're now going to have to do the note for that. You'll have to look at that as part B. Working 2 then, so not writing out big essays for the standards, just writing down the facts of the case and moving on. Showing the examiner you know what to do it using your journals. So we're told here then at the start of the year you paid 600 grand for a building to relocate some of your staff. So that means that would have been IAS 16. However, on the 1st of February, a month later, it was let to a third party. So transferred from a PP to an investment property. But then in October, it transferred back and they relocated the staff back there and you're told the fair value at the year end. No depreciation in your purchase and full depreciation in your sale. And they use revaluation for PPE and fair value for investment property. So this is quite tricky now. So we have a couple of things going on. So let's just break down each one. First thing is you're writing IAS 16 PPE and IAS 40 investment property. Just show the examiner, I know the standards and I'm not going to regurgitate out something they don't want to see. So on the 1st of the 1st, so on the 1 Jan, what you're going to do here is you're going to debit PP and credit bank. So you're not told any entry has been met. No entries have been made, so that means you're going to have to make all the entries from scratch. So just read carefully the guidance the examiner gives you. So increase PPE by 600 and credit your bank by 600. That's fairly straightforward. However, on 1 February, it changes. What happens on 1 February is it now becomes an investment property. Now, under IAS 16, when you're transferring from PP to investment property, you get the revalued amount first, and then you transfer over. So this is a property, plant and equipment reval. PP reval is first. Because there's no depreciation, you're merely just debiting PP 200, crediting reval reserve 200. So make sure you understand now you need to deal with the property and revalue it up to 800 and then you get rid of it to investment property. Then you take out the 800 and you debit investment property 800. So before you transfer, you deal with the reval. So you now have an investment property of 800. However, in the 31st of October and Halloween, it transfers back and the fair value was 750. Now this, before you transfer back, must be dealt with and the fair value of an investment property. And that any fair value movement goes straight to the P&L. So it's slightly different there now, just be careful. On the 31st of October, you're going to debit the SOPL, the loss, and you're going to credit investment property 50. So before you make the transfer from one type of asset to another, you deal with the fair value adjustment. So that means then it's going to be debit PP 750 and credit investment property 750. So there was a lot of movement going on there, and as the examiner said, it was quite weakly answered. Students didn't understand, none of those entries were given, so you're better off going it down by line just to make sure you get everything and it's required. So just open up this a second. So what an easier thing to do here now is just give the net journal, because you want to take forward, you're not going to be making all those entries. So the net journal here, just so you can take it forward, is, well, PP is now going to be left at 750. That's where it is at the year end. So there's no depreciation charge, you're told. So it's left at 750. You're crediting the reval reserve 200. That's from the initial transfer. It's not impacted by the reduction of 50, because that reduction of 50 occurred when it was an investment property. Just be careful of that. You're then going to debit your SOPL 50 with a loss, and you're going to credit your bank 600. So the net is what you're looking for there. A lot of students wouldn't have got the net straight away. You'd have to work down through it. So just watch for that. Quite a tricky one, but an examiner favourite to try and give you a bit more complicated in terms of sequencing and how you deal with the transfer to and from IAS 16 and IAS 40. So now clearly labelling, working 3. Again, some people want to put in those adjustments, that's fine. I leave it at the end. But either way, you'll get your marks as long as you time it correctly. Third one then, we've already flagged here. This is a construction of a new factory and it's financed through a loan. And we said straight away IAS 16 is relevant, but so is IAS 23. Because only half of the loan interest remain unpaid. we looked at the trial balance, we only have the paid amount in. So no entries have been made again. So use the examiner's guidance to help you along. So in this case, 2.4 million spent on the construction of a new factory. That's your first entry. Debit PP 2400, credit loan 2400. So 10-year loan, that's going to be a non-current liability, NCL. However, we also have to deal with the interest, because under IAS 23, if certain criteria are met, you can capitalize the interest and you can write it off over the useful life. If the criteria isn't met, then you have to expense it to the P&L through finance costs. So we're told then, 1st of February, the loan was drawn down and lodged with 1 month earning interest of 10,000. No further deposit interest was earned. Construction began on the 1st of March. So be careful now for the interest from 1 Feb to 1 March, that has to be expensed. Right? That does not qualify because you can only capitalize it once the loan has been drawn down and construction has begun. So that means it only starts capitalizing the 1st of March. And then from 1 March to 1 July, you can capitalize. So that here is 1 month. March, April, May, June. That's 4 months that can be capitalized. Once the strike starts, that's not allowed. And then so for July, you expense 1 month again. For 1 August to when the construction was complete, 1 December. So August, September, October, November, December. You can capitalize there 5 months. So August, September, October, November, 4 months. And then for December, although the loan is still outstanding until year end, so loan is still, it's a 10-year loan, construction was completed on the 1st December, that means you stop capitalization. Even though you still had December, you still had interest, because you still have the loan, you have to expense it. Because you can only capitalize it when the actual construction is occurring. Once it's finished, or it's strike, which is here, then you're not allowed. So in this case, you have 2.4 million. So the annual interest is 2400 times 5%, which is, in this case, would be 120. So you're going to expense, just be careful now, you're also going to expense, I'll include up here, when did they draw down the loan? So it's only drawn on February, I thought January is there. So the annual interest actually here is only 1 times 11 over 12, because you only brought it in February. Just be careful, you didn't have that for January. So that means, in this case, you're going to expense 1, 2, 3 of that. So you're going to expense 110 times 3 over 11, which is 30. And you're going to capitalize 4 months and 4 months, which is 80. So that's important to understand. Of the 11 months, 3 have to be expensed because they don't meet the criteria, the other 80 does. But just be careful the way they've said it, half the loan interest remains unpaid. So that means you've paid 55, but the other 55 have to be accrued. So watch your entries here, none of these adjustments have been made. So we've already recognized the loan and the asset. So here then, you're going to debit SOPL, finance costs. You're going to debit that 30. You're going to credit, right here. So you're going to debit PPE, should I say, 80. That's the amount you're going to capitalize. You're then going to credit your bank. So the bank here paid 55 in interest, and you're going to credit accruals, which is a finance cost accrual, the other 55. So that's saying 110, some of it capitalized, some of it written off as an expense, and half it paid, half it accrued. The other thing that we forgot was you're going to debit bank 10 and you're going to credit other income 10. That's the amount of interest you earned for the first month. You're told in the question here they earned 10,000. That just, it doesn't be netted off against it because it doesn't qualify because construction wasn't started. So that is merely put as other income, deposit interest. So there's quite a lot going on there. We have a couple of adjustments for the P&L, for property, plant and equipment, and we're going to have to deal with all those as we go down through it. So you'll get your marks for your journal entries, which you have to finish off the financial statements, which can take a bit of time as well. So it was IAS 16 and IAS 23. So neatly label them, working forward to make sure the examiner can follow what's going on. This is closing inventory, so just write down there IAS 2, lower of cost and NRV. Nothing more than that. Your cost here is 48,000. Right. Related to a sports event this year, you're now to reprice them at 8,000, after which they can be sold for 50% of the normal sales price. And you're told they usually make 20% margin. That's not markup, just be careful. That's 20% margin. So 20% margin means cost is normally 80%. Percent margin means cost is normally 80% of sales. So normal sales price here would be 48,000 divided by 0.8. A lot of students mistook markup for margin there. So watch the difference and make sure you read the question carefully. So 60,000 is the normal selling price. So your NRV now, you're told, is going to be half of that, 30,000, minus the 8,000 you need to spend to actually get to that state. So net realizable value is what you sell it for, less what you need to spend, 22,000. So that means 48 or 22, you use the lower, just don't hide these for a second. So that means you're going to have to write down inventory by the difference. The difference here is 26,000. So where students, quite basic one, so get your easy marks. Where students went wrong there is they treated it as markup, it was actually a margin. So you're going to debit your cost of sales, credit your inventory in your SOFP. 26 and 26. Just be careful, I know I'm interlinking full numbers with dropping the 3 zeros. So usually for the financial statements I just drop the 3 zeros. Makes it easier to follow. You just reference it, IAS 2, get your mark, and get your mark for your journals. So that was our working 4. Nice and neatly labelled for the examiner. Working 5 then. We've already flagged this is an issue, is IAS 21. So it's a foreign sale. Credit sale to a US customer, incorrectly recorded as a sale of 200,000 euro. So we know that's wrong. You should be recording it at the exchange rate. So what we'll do is we'll reverse this. This is IAS 21. Record sale at spot rate. So here you're going to debit revenue 200 and you're going to credit trade receivables 200. So that's you're reversing the incorrect accounting there. Shouldn't have been 200. It should have been debit trade receivables and credit revenue. And it should have been at 200 divided by 1.25. Why? Because that's the spot rate at the date of transaction. So 200 divided by 1.25 is 160. So if you came up with the net journal, that would have been fine, all right, as well. Reduce revenue by 40, reduce trade receivables by 40. What they also haven't done, and it's a rule under IAS 21, is you must record the partial payment. So half the bill has been paid on the 1st of November, and you record that at the spot rate then. So they haven't recorded this at all. So you're going to debit bank 100 divided by 1.2. That's how much you got in, $100 divided by 1.2, which is 83. So we're just rounding. And you're going to credit trade receivables. Just be careful now. You're only crediting trade receivables the 80. Because that is half of initial amount. You're saying half of that is now gone. So that means the remaining credit, FX gain in the SOPL, is 3. You made an FX gain there, and we'll call that FX gain on settlement. So you made an FX gain on settlement there of 3, because you settled it for 83. They settled it for 83, sorry, whereas you thought it would only be 80. Be careful, you also now have year-end translation. Because if you have $100,000, that must be retranslated at the 1.1. So at the year end, that remaining balance should be 91. It's currently in the accounts at 160 times 50%, which is 80. So you have an FX gain there of 11. So remember, IS-21 says you have a gain or loss on settlement if you settle during the year. But if you have a monetary amount, and trade receivables is a monetary item, it has to be retranslated at the year end. So in this case, you're going to debit trade receivables, 11, and you're going to credit the SOPL FX gain at year end of 11. Right, so quite a lot going on there, but it's important you understand exactly what needs to be done. Right? There's how you record IS-21, record initially at spot, record the settlement at the date of settlement, and don't forget the monetary item, which is the trade receivable here, must be retranslated at year end. So just if you wanted to give the net journal to make it easier to follow, you're debiting revenue, 40. So the net journal layers, the two come to reduce revenue by 40. You're reducing trade receivables by 40 here, and reducing it here by 80. So that's reducing it by 120 and increasing it by 11. So the net reduction here, credit trade receivables by 109. You debit your bank, the 83 that you got in, and then you credit your SOPL FX gain, 14, which is the gain on retranslation and the gain on settlement. So sometimes students like to do the net journal to make it easier when you're finishing off the question what the adjustments are. That's personal preference, but I like to just summarize it. Not many students can skip to this step straight away, but particularly when you're trying to finish off the question at the end, it can be helpful to have it there ready to put in the adjustments. So that's our working 5. We've referenced IS-21, we've shown the examiner, we know what we're doing. Working 6 then is a dividend was declared after the year end, watch the dates there, and they accounted for before the year end. So under IS-10 that is not allowed. It must have been declared and approved before the year end to be accounted for. So you're essentially saying reverse that out. So IS-10, dividends declared post year end, not allowed to be accounted for. They should be accounted for in 2018. So you're just going to credit retained earnings and debit accruals. To say that's just reversed. Nice straightforward one, but again, to get your marks, put in the journals and give the reference to standard. Not an essay, just a short little piece to show you understand why you're doing the adjustment. And the final working, then working 7, we said here the current tax asset in the trial balance, which we know was 22. I have it here. You're told that was repaid by the revenue in March. So all you're going to do is debit bank 22. They repaid us the money they owed us, and you're going to credit current tax asset to remove it from the balance sheet completely. So that's not going to be there anymore. That's just a removal. And then IS-12, your tax estimate for the year. That's a very common one that's always there. Your estimate is 285, so you're going to debit the SOPL tax, 285, and you're going to credit tax in the SOFP, a current liability, 285. Your estimate for the year, which you put as an expense and a corresponding liability. So not the worst at all. Key thing is, put it structure. My preference is to leave pages at the front, so the first thing the examiner will see is the neat answer. Then go to a separate page. You don't care how long the workings are then, because you've left enough space, and neatly label them. Working 1, working 2, working 3. Some students like to open up what I call aggregating workings for cost of sales, for property, plant and equipment, and that is fine. You can open them and slot them in as you go. Some students prefer to leave it at the end. That's entirely personal preference. The key thing to remember is keep it neat, and now at the end you need to leave time to actually finish the question. We have to come back up now, and what you're essentially going to be doing is juggling between your trial balance, which you're given here. You're going to be using that as a baseline, and you're then going to be checking through your notes to figure out, right, what adjustments do I have for each line item. Takes a bit of time. Some students have different labeling systems, and that's fine as well. Whatever works for you. So for example, we'll start off with revenue. How do I start that? Will I start off with my trial balance? My revenue per my trial balance here, you're told, is 44256. So the way I kind of put it in here for the examiner is, I just leave the note. Sometimes I put it in, sometimes I leave it as separate working. 44256. Doesn't always leave it like that. You might want to leave it separately, or what sometimes I do is put the trial balance, just to show where it's coming from. 56. What adjustments have we for revenue? Well, we did have a couple, I remember. Just be careful here now. We had one here, a minus 60, working 1. We had another adjustment in working 5. The net journal, remember we did net journals here to make it easier, another minus 40. So it just makes it easier if you do that net journal down. So you now have minus 60, minus 40. Now I can't do that in Excel, but what I like students to do if they can, is what you'll do is annotate over where the numbers are coming from. So in that regard, you will put a little tab under that, trial balance, just in maybe green bar or black bar. You'll put a little one here, working 1, and you'll put a little note under 40 at working 2. Just so the examiner can see where they're coming from, and you'll get your presentation marks. There's nothing worse than not being able to follow where things are coming from. Cost of sales, similar adjustment. Start off with 30,820. You then go down along and think, have I adjustments here? I have adjustments here in cost of sales. Debit 100, which is increased cost of sales. Debit 200, so it's 300. And reducing cost of sales by 36. So here, that'll be plus 300 minus 36 for cost of sales. Just be careful and make sure you understand and label them then that's working 1, so the examiner sees where it's coming from. Just checking the rest of them then. Do we have any other cost of sales adjustments? None here. None here. Working 4, we have another increase of cost of sales by 26. So just take a bit of time. You have to go back through them. So that's why it's important to have your neat workings, because otherwise you won't be able to follow them. And we just tot them up. Nice and straightforward. So that means our gross profit will be, I've gone wrong there somewhere, 3820. That's 264. Of course I missed one. Working 2. I flew by it. So this 50, the loss they've put into cost of sales and solution, that could have easily went to expenses as well. So we'll just be consistent with the solution. They're putting 50 in here as well. And that is from the fair value movement investment property. If that went to admin expenses, that would be acceptable as well. So your gross profit then is one from the other, 12,996. That should be fine. Now here's the one where you need to go back and just check, is there any other line items? We have one other income, which is 10, and that is coming from our working on the loan interest, which is working 3. So let's reference working 3 there. Now I said you'll try and reference them. Just because I'm working Excel, I can't annotate them, but you will reference where you're getting these figures from. Just a little mark to show the examiner how neat you can be. Distribution costs we have in the trial balance. In our trial balance, your distribution costs are 6965. Just put it there. And admin expenses, just to slot them in, you might even do this to start, are 3421. So just have a double check then, is there any adjustments to distribution costs or admin expenses as you go down along? I don't think there were. The only one that might have went in there is the movement in the fair value of investment property, but we've put that in the cost of sales. So in that regard, I think we're okay. We don't have any other adjustments, so we just slot them in. 6965 and 3421. And what I might just put there is instead is trial balance. Just to note the examiner, both of those are coming from the trial balance. We have another adjustment here, your FX gain. We know that's from our working here, your working 5. Remember, we had an FX gain of 14. Right, so maybe this is a learning point here. The easier thing here actually might be just to put a negative for these. Just in case you confuse yourselves, just put those in negative so it's easier to understand. And the other ones as positives, which are the gains. Just might be a bit simpler when you're going down along. So you have an FX gain there. So you can center that up of 14. And we're trying to figure out then our finance costs. We do have one or two workings. Finance costs paid were 328 in the trial balance. So you always check the trial balance, then check the workings. So go down along. Finance costs another 30 for finance cost there. So you're going to add on 30. Right. Just bring that up, 328 plus 30. And you'll reference there your working, which in that case was working 3. So just show the examiner where it's coming from. Minus 328 minus 30. So hopefully that's most of our P&L items. Again, always just go back and eyeball the trial balance. Tick these off as you cover them. Right, we've used a lot of these already. Just tick them off in case there's anything else that stands out. It's a good discipline to get into. And tick off your notes then as well as you cover them. So as you use a journal and indulge it, just put a tick beside it. So I don't think there's anything else we have there that's relevant for the P&L. So again, it's just get discipline, whatever works for you, but you need to practice because it's very easy to miss a thing either in the notes or in the trial balance. Our tax we know there is working 7. That is minus 285. So you just take that directly. We've removed the current assets. So your profit after tax is 1991. And remember, we did have a revaluation reserve. So always check. You have a valuation gain. So that means you're going to have total comprehensive income. The reval gain here is coming from your working 2. So if you go back, remember you switched it during the year. It went from property, but before it went to invest in property, you recognized a revaluation gain. So that is a reval reserve OCI plus 200. 200, and you're referencing working 2. So that means your total comprehensive income is 2191. And that is your statement of profit and loss and other comprehensive income complete. So while getting the journals, getting the workings done are good, you need to have them cross-referenced. This is what the examiner is looking to see. There are your presentation marks. It looks very professional. And you need to make sure you get the numbers into the P&L. That's a 2191. Now you can start with the P&L or you can start with the statement of financial position. Either or is fine. There's probably going to be some dependency when you get to retained earnings, etc. Right. Intangible assets we've actually finished already. So you can just go down. We've taken that figure. Remember we completed in the start. Some students might have put it in. 18796. So we actually have that done and we can just slot it in. 18796. This makes it a bit easier. Property, plant and equipment. We know we have some workings as well. In the trial balance, PPE, at the year end, so remember depreciation is already done. We don't have to worry about it because it's told it is at the year end. It is 36.4. But we did have some adjustments, if you remember, from working 2. And we did the net adjustment in working 2. We brought the property, plant equipment, we brought it out and brought it back again. The net adjustment there was an increase of 750. So you can see there the benefit of doing those net adjustments. It makes it easier when you're finishing off the question. So you'll get those little tips the more you go through questions. And the other adjustment then is 2.4 million and an 80 in working 3. So you're capitalizing the interest and the cost of the factory. So you have 3 separate adjustments there that hopefully you'll remember as you're going through. Plus, in this case, we were looking at 750 plus 24 plus 80. And again, if you're in an exam, what you'll do is you'll put a little trial balance over the 36.4, put working 2 over this, put working 3 over these two, to show where they're coming from. Anything that makes the examiner's life easier, they'll try and give you marks. So hopefully there, you got 39,630. And just a quick look at the trial balance. Is there any other long-term assets, such as financial assets or anything like that? And you'll have a lot of these ticked because they're done already, but there's nothing else that seems there. So just leave the space when you're setting it up. But if there's nothing else, you just add those together. And that is our non-current assets. Your closing inventory we were given on the balance sheet was 468. However, we know there's an adjustment. If we go down, remember we had our lower cost net realizable value. So you're trying to remember these as well, it's a helpful one. You're reducing inventory by 26. And so inventory has gone down by 26. So 468 here minus 26. And put a little reference under that. Your working there for inventory will be reference your working 4. Let's just show the examiner where it comes from. Which is 442. Trade receivables as well. Remember we did have one adjustment because the IAS 21. So your trade receivables, your starting point is here, 1240. And your net adjustment to receivables, if you remember, from our IAS 21, which is working 5, the net adjustment, which is the benefit of doing here, was minus 109, crediting your trade receivables. So reduction in 109. So therefore your trade receivables are 1131, and you put a little reference to working 5 there in your receivables. Bank and cash, same approach. Starting point is the statement of financial position. The trial balance, which you're told cash and cash equivalents 920. And then you come down along with a couple of adjustments here. It's just we're trying to collect all of them. So we credit a bank, which is the net journal adjustment of working 2. We bought it for 600. In working 3, we paid half of the interest, so credit 55. But we also got in interest income, so that'll be debit 10. So you're adding on the 10 there. That's your cash and cash equivalents. In working 5, you got money in, 83, which was from the foreign sale, the part payment of it. And then in working 7, you got 22 in from your current tax asset. So there's actually a couple of adjustments there. Might be better off to do them as a separate working because you mightn't be able to fit them all in. But it's no harm to work your way through just to make sure you can follow. So here it's 920. You're starting off by minus 600, which is the amount paid for property in working 2. Then you're saying in the next one, which is your working 3, pardon me, you got in 10, and for interest income, you paid 55 for interest. Then you come on to the next one, which is working 5, you got in 83, and then you got in 22. So it's quite a lot of adjustments there. Probably not that need to keep them all like that. You might want to do a separate working 8 and just cross-reference in working 8. But again, that's personal preference. As long as you come to a final answer of 380 and the examiner can see it, you'll get your full marks. But just try and show there is stages going through this question, and showing your final financial statements and where they come from are important as well. So that means your total assets are 6379. Ordinary share capital and share premium haven't changed, 30,000 and 10,000. They're coming directly from the trial balance. So tick that off, tick that off. Retained earnings, that's the opening balance retained earnings. So in our case here, you're going to take the 6282, you're going to take off, add back the 70, which remember is working 7. Our working 6, your dividend adjustment. Dividends shouldn't have been taken off, so you're going to credit retained earnings, and then you're also going to add on for the year the profit. Now be careful, you're adding on this 1991. This other 200 goes to revaluation surplus. So don't mix them up. It's not the 2191, it's the 1991. Right. So 6282 plus 70 plus 1991. Hopefully you get 8343. Your reval reserve, we can reference there working 2. Just double check, do we have anything in the trial balance? There's no other reval reserve there. So that means it's just the 200 that's in this year. And that gets you your total equity of 48543. So you're using the trial balance, you're using your notes, and you're trying to keep it as neat as possible. It won't happen straight away. It will take a bit of time. Non-current liabilities, again, you'll always have these sections set out at the start. So you may or may not have items in them, but you won't lose marks if you leave it blank. It's just a useful reminder to check. We had one non-current liability here as an adjustment, the 2.4. But we also have to look, do we have any other non-current loans? You have 8.2. So you have 8,200 here, 8.2 and 2.4. Which gets us 10.6 of non-current liabilities, which I'll just bring over here. So you can reference beside that then, that's your working 3, which is the 2.4 million. It's just, I won't put them in, but sometimes students do it like that. Or what they might do is put it on top in smaller writing. It's just not possible with Excel. Trade payables, we've had no adjustments, so it's just the trial balance. Trade payables here, 896, so I just reference there TB, 896. Your tax is working 7, that would be 285. And don't forget, we also have accruals. In the trial balance, your accruals were 70, but we know that's all to do with the dividend. So that 70 is actually going to be removed. And what the only thing you're putting in its place, if you remember when you go down, so we said the accrual in working 7, that should have been removed, or working 6, sorry, debit the accrual. But we should have created an accrual for finance costs in working 3 of 55, because we owe half a year's interest at the year end. There's quite a lot to remember, but the trick is tick them off as you go. As you put in an adjustment, or as you put in a line item in the trail balance, give a tick. And then you'll be able to spot very quickly which ones you've left out. It's the foolproof way of making sure you have everything in. So tick after each element. So come back there then, and that means your closing one will be 55. And hopefully, if I've done my job right, these 3 will tot. And when we add these together, 1236 plus 106 plus 48543, we have a balancing statement of financial position. Now you mightn't always get a balancing, but your first port of call is, have I everything included? And that's where the tick mark comes in, whether it's a green bar or blue bar, whatever. Use those ticks to make sure you've captured everything. It's very easy to forget something, particularly in working if they're not neat or in your trial balance. So you can see the steps there. My preference, set up the statement at the start, do your workings out, and if you get a chance, slot them in as you go. But you do need to leave time at the end, because otherwise you won't finish the question. Now, it wasn't asked in the question, but I'm going to show you anyway, just because it hasn't been asked since 2016. Statement of changes in equity. Your first port of call here is the number of line items you have in your equity section. We have 4 here, and these balances, they become the number of columns. You're going to have 4 columns plus a total in your statement of changes in equity. This statement is always left to last. There's actually nothing new in it. It's merely just presentation. So your first port of call is you're going to have 4 columns, and then you're going to have a totals column. So that makes it straightforward enough. And your first port of call is the closing balances are just taken from the statement of financial position. And just tot them up, and you get your total. So there's nothing new there. Your total equity is 48543. So just put there, that's all from the statement of financial position. So that's your first port of call, is put in the closing balances, and there's marks going for that, if you're asked to do it. Your second thing then is, what moves these during the year? Well, this is where cheat sheet comes in. What are the types of things you're looking for during the year? Number 1, what was the profit for the year? So in our case, we're going to have TCI for the year. What was the total comprehensive income? That comes to the P&L. So you need to have your P&L done as well. Did I have any share issue during the year? There's no share issue here, so you're not too concerned. And did I pay any dividends? Well, you recorded a dividend during the year, but you said that was incorrect. So actually the only movement you have here is your total comprehensive income. And here's where you need to be careful. Your total comprehensive income of 2191 is split between retained earnings, which is your core profit figure, and the revaluation gain. So you put the 1991 here, and you put the 200 here. So you still have the full amount in, but be careful across which columns you do it. So that's your step 1, step 2, and your opening balances, they are actually the plug figure. So nothing happened during the year, so opening must have been 30, 10. Opening balance and retained earnings must have been, taking off what you added on during the year, must have been 6352. Opening balance and reval reserve must have been nil. Again, you can just by default then get the opening balance and the total. But the key thing is to sense check whether you're right or wrong is, do these make sense? Is my opening reval reserve nil? Well, it was, because if we look at the trial balance, we didn't have any reval reserve at the start. It wasn't there, and we added 200 during the year. So that makes sense. We're right in that track. Here it's telling me my opening retained earnings should have been 6352. So I'm checking back to my trial balance. It says actually the retained earnings at the start of the year were 6282. But we know the difference, 6282 per the trial balance, and the correct 6352 per the statement of changes in equity. The difference there is actually the 70. And that is the dividends adjustment. So you're saying ours correctly should be 70 higher because this figure includes dividends already taken out. So technically it's not at the first of the first because they've actually, as per their adjustment 6, they have debited during the year 70. That was incorrect. So this technically is 70 too low, which is what I have. So you can always use your statement of changes in equity as a sense check. It hasn't been asked in the last 2 or 3 years, but it has been asked. Look at 2015, 2016 papers. It's a nice 5 or 6 marks. You always leave it to last, and there is nothing new in it either. So that looked at Summary 18 question 1. The key thing I want you to focus on is the approach. Number 1, you read the requirement. What was I asked to do? We just focused on part A here, particularly the journals. You have to go on and do a note and ethical issues for the remaining number of minutes. The second thing you do is you do an eyeball test of the trial balance, noting anything unusual. Because then you go on and you do a quick read of each of the notes, try and link it back to the trial balance, such as the closing balance here, matching here. Try and identify the relevant standard, or there could be multiple standards, and see is there any link between notes, because you might have to do 2 notes together. Once you have an idea of that, you set up your answer. My preference is to leave the first couple of pages for the financial statements, and then it doesn't matter when you actually start your workings how long they go, because your space is left for the financial statements, and it looks quite neat. And what you've seen is one of the things that takes the most time here that you have to leave space for is finishing off the question. How you transition from your workings there to the actual finished financial statements, that takes practice. See what works for you. Do you want to lay it out like this and label them as you go? Do you want to open up a working 8 and do all your aggregation workings there? Or do you try and slot them in as you go? That's entirely personal preference. The only way you'll figure out what works for you is trial and error and practice, practice, practice after that. So that was Summary 18, question 1 in Cap2 Financial Reporting.